get by. It resides between my eyes. Walked through the fire, came out better on the other side. See, life's like a beach if you find the sand. And right now, I feel like 100 grand.
You are listening to Inspired Insider with your host, Dr. Jeremy Wise.
Dr. Jeremy Weiss here, founder of InspiredInsider.com, where I talk with inspirational entrepreneurs and leaders. Today is no different. I have Dan Lee of Pin High Strategies. You can check them out at pinhighstrategies.com. Dan, before I formally introduce you, I always like to point out other episodes of the podcast people should check out. Since this is part of our private equity series, I just want to mention, and the reason we met Dan is actually Lou Sokolovsky. And he talked about mastering M&A, networking, and deal making. It was a fantastic episode. He's like a true giver and connector. So thank you, Lou, for making this happen. And I just had Adam Coffey on the podcast, who talks about, private equity and some of the stuff he's done. Another interesting one, Dan, maybe a good introduction for you, Vivian Gonzalez, who basically does more executive search for private equity-backed companies. So that's an interesting one. And same thing with Patrick Rapella. He does a lot of, different things, and he helps with private equity sometimes in the chemical industry and some of these interesting high-tech industries as well. So that and many more on InspiredInsider.com. This episode is brought to you by Rise25. At Rise25, we help businesses connect to their dream relationships and partnerships. We do that in a few ways. One, we're an easy button for a company to launch and run a podcast. We do the strategy, accountability, and the full execution and production. So you just get to develop relationships and chat, and we do everything else. And number two is we're an easy button for a company's gifting. So we make gifting and staying top of mind for clients, partners, prospects, even staff from a culture perspective, simple, easy, and affordable. So just give us the addresses and we will send the gifts. And Dan, it's not like we send one gift. We like to think of it as a campaign of gifts. So think every 4 months for 3 to 4 years to these people. And we do the same thing for our clients and partners. So, Dan, we kind of call ourselves the magic elves that run in the background to make it stress-free for a company and help them build relationships. And that's been the number one thing in my life over the past couple decades is how do I give to my relationships? And I found no better way than to profile them and share with the world what they're working on the podcast and send them sweet treats in the mail. So check out rise25.com or email support@rise25.com. And now I'm excited to introduce Dan Lee. He's built 2 lending platforms, including Comvest, which he took from $250 million to $12 billion over his 14-year tenure. And he tried his hand at private equity late in his career after getting fired, and he decided to become an entrepreneur, launching Pin High Strategies. And Pin High Strategies helps support founders and independent sponsors, build stronger platforms. So Dan, thanks for joining me.
Thank you, Jeremy. It's great to be here.
We're going to get into, I really want to dig deep on Comvest and what does the journey look like from 250 million to 12 billion. But let's start off with Pin High Strategies and what you do.
Of course. Yeah. So listen, relationships, you nailed it. And what Pin High Strategies is about is capitalizing on relationships that I have had for 30 years, people that I've wanted to do business with. And now I get to choose who I'm doing business with. And we've got just some incredibly high caliber clients. We're serving independent sponsors and founders, helping them scale their platforms and raise capital. And we have just some amazing clients. A guy named Corey Singman at BBI Capital has been a foundational client for us. We're just lucky to serve a really unique universe of people. And I get a chance to go deep with them and to figure out how we can be collaborative together as opposed to being transactional.
Did you serve these? So I'm looking at, if you're listening to audio, we are on Dan's website here, pinhighstrategies.com, and it says who we serve: independent sponsors, private equity firms, family offices, founder-owned businesses, strategic acquirers. Do you serve all these in similar fashions, or are they different?
So it's different. For independent sponsors, we're typically helping them raise the capital. With the private equity firms, family offices, we are bringing them to the table, bringing deals to them. as potential opportunity. And then founder-owned businesses is like the independent sponsors. We're helping them raise capital and really to think strategically about how they can optimize their growth and what type of capital, what type of operating partners, resources can help them to really scale in a more healthy way, in a way, frankly, that a private equity firm would think about it. So it's bringing access to private equity resources to founder-owned businesses.
I want to walk through maybe an independent sponsor example, and I guess that goes with a founder-owned business example. For people who don't know, first explain what an independent sponsor is, and then just walk me through a scenario. They come to you, and how does it work?
Of course. So a little bit of context here. Independent sponsors didn't exist 20 years ago. So this is an ecosystem that has grown, really started coming out of the great financial crisis. There were a few before that, but they really started exploding in the mid-teens. And you've seen it grow from a universe of a couple hundred people up to thousands and thousands, literally. Independent sponsor is a guy or a group who decides, I want to buy a business, but I don't want to raise capital. I just want to focus on the business. And in many cases, it's someone that's spun out of a private equity firm, decided
they're going to run the business also? They're going to buy it and run it?
In some cases, it's case by case, but some are just looking to invest and partner with the management team. Some will get more operationally involved for sure. But they realize, I'm tired of being part of big companies, big institutional private equity, quarterly board meetings, no real impact on the ground. I want to go roll my sleeves up. And so that's what independent sponsors do. And they're attractive to founders because they're entrepreneurs, right? So they're starting their own firm. They're taking a chance on themselves. They have no funding. They have no fund that's paying them a management fee. And they have no team typically. It's them, one or two people that are looking to partner with a management team. They're also a lot more flexible in structure. So they tend to be more willing to do a non-control stake with the investments in a company. Private equity typically in the vast majority of cases requires control. And so for a founder who's looking to maintain control, but raise capital and again, get access to private equity resources, independent sponsors are a really unique way to thread that needle.
So do they come to you and they have a thesis, like I'm looking for a certain type of company, or do you help them with that also? Like when they come to you, what's the situation look like?
It typically is more advanced. They've got a company that they're deep in discussions with and or under LOI, and they need to raise the capital. We certainly get involved with them before LOI, but thesis development, they're typically handling themselves and coming to us. We'll certainly collaborate with them and give them our thoughts. We are a source of deal flow once they've developed that thesis. So we bring, it's very common, we'll bring deals to independent sponsors once we know where they're focused. We're heavily focused on consumer services and products, including multi-unit services and healthcare. Those are kind of our primary areas of focus. And so we have a group of independent sponsors that I've known for 10 plus years that we will bring deal flow to, very highly curated deal flow. And then on the flip side, they'll come to us when they're looking for capital. In some cases, we'll help them. We'll show them the deal and help them raise the capital. So we really, there's a lot of different ways we can add value to an independent sponsor looking to acquire a company.
Is there a typical place where they engage with you? Because you mentioned they may be under LOI, then they contact you. I imagine that's a little more stressful than if they contact you before and then go under, like try and buy a company, but I don't know.
So it depends on how well we know the group, to be honest with you. It depends on how much success we've seen them have. If it's someone that we know we've seen has a track record of getting deals done, we're likely to engage earlier with them because we know that they have well-developed DCs and they've closed transactions, they've managed businesses, often and exited businesses. But the answer is both have their stress. Someone that comes to us before LOI, yes, there's more time, but they might not get it under LOI. So that might just be spinning wheels versus LOI. Yes, more stress, but we've got time to get the deal done. And often that makes you more credible with capital providers. Having it under LOI gets you a different level of traction in the capital community.
It's really interesting. And are they typically looking to roll up other companies? Because you mentioned you bring other deals. Is that typical? Like, okay, this is the first one, but we're looking to do 5 others in the same space, or they're not going to just stop at one typically?
So it's probably the most interesting development in independent sponsor land. When it really started to bloom 15 years ago. It was a group, an individual or two or three people buying a company. And that was the kind of common model. You buy a company, you focus your time on that, you build it, you exit it. What's happened
That's
is,
what I thought you were going to say, but then you said, but we're bringing them deal flow. So
yes. Well, so what's happened is they've realized that they've got more bandwidth and they don't need to focus all of their time on just one. In some cases, if it's a higher intensity situation, certainly they will need to. But in many cases, the company is running fine. They just need growth capital and guidance. The independent sponsor is plugging in operating partners or providing strategic input, but they're not on the ground. And so they're almost more of an active chairman role. And so they've got leverage. Look at other opportunities. And because they have the credibility of closing a deal and they've got a management team that will reference for them, they find that there's a little bit of the dog that caught the car. They start getting inbound deal flow because I see that you're a founder friendly, transactional, you're relationship focused. You're not just transactional, but you know how to transact. And so we've got our largest client, BBI Capital, has 6 portfolio companies. And these are meaningful businesses. They've got EBITDA of 20, 30 million and upwards. And so that's one of the most exciting developments. If you look at the number of independent sponsors that owned more than one portfolio company 10 years ago, it was a handful. There just weren't many. Today, I can give you a list of 100 that own at least 2, and I can give you a list of 30 that own 4 to 5 plus. It's really pretty remarkable how they've grown. And last thing I'll say, Jeremy, we're on the stage, the next stage of growth in independent sponsors, because what fuels growth in independent sponsors is a difficult private equity fundraising environment. So when it's tough to fundraise in private equity, the mid-tier and even senior guys get frustrated because they're not doing new deals. They're not raising new funds. There's no place to go upward in the firm if the firm's not growing, right? And so you're really managing the portfolio. And in many cases, these are over-levered businesses. It's frustrating. They want to go roll their sleeves up. And now they've seen this is a model. It was really risky coming out of the great financial crisis because it hadn't been done. Now it's being done. So now you're going to see a lot of people following this path with the fundraising environment being so difficult in private equity.
interesting. I want to talk about going deep in niching. Okay. Maybe we'll start with the present and then we'll talk about a life lesson that you learned in this.
Sure.
Because I can't wait to hear it. But you mentioned a couple specific niches in going deep. Now, talk about what that looks like now for your company, and we can talk about life lesson later.
So look, I think the key in going deep is at the relationship level, realizing fertilizing your background, farming in your backyard, rather than worrying about spreading seeds around the world. And so, I now know where I matter. And where I matter is in the people that I know personally, who I have a long-term relationship with. Maybe we've done business together, maybe we haven't, but I know we've helped each other over the years. So this person has shown me that they're collaborative. And that to me has made a massive difference in how I'm spending my days. It's really in figuring out how can I be of service to the people that I know I'm going to build an ecosystem with. And that ecosystem is my first and second degree nodes of the network. How do I figure out how to build an ecosystem of people that I know they're all collaborative? They may know each other, they may not, but they're not focusing on each other. So let me figure out how we can build this together and really, create strength in numbers. And but within a very tight knit web of people, right? Let's get more deals done within this little cluster rather than focusing on trying to do everything everywhere.
What was the life lesson?
So the life lesson was I left Comvest. Comvest is a great platform. I love the team we built, our leadership. I mean, we had it was a great run, but we had just gotten so big. I really like the lower middle market, and I enjoy independent sponsors. I did my first independent sponsor deal in 2006, and I wanted to go back.
What range of revenue do you define as kind of middle market? What is that?
So I think of it more EBITDA tends to be in that kind of 3 to 15 million level. That's the lower middle market, I would say. And so when we got to 12 billion, frankly, when we had, past 7 or 8 billion, it gets really hard to access the lower middle market. It's hard to justify writing a check less than 50 million per deal. That's just a business reality, right? That's no one's fault. It's just a reality of growth.
Because
And
certain
so
things, it just won't move the needle as much. So it
that's
doesn't make sense.
exactly. You need
But
to
you
put
could
out.
spend the same amount of time on this deal than that. So you're choosing much larger deals.
You have to. Yeah, it's just if you're going to scale and continue to grow, you've got to show investors that you can go upmarket, and you can't do it by writing $120 million checks. It just you can't scale that way. And so
Yeah.
it's just a reality of scaling. And I realized I was bored. I like doing smaller, creative deals, and that part of the market is less competitive. It's more fun. And so I decided I was going to make a move over to the private equity side. I went to Garnett Station and was gonna focus on the lower middle market, independent sponsors, and was super excited about it. I had known those guys for a long time. I'd done 5 deals with them. The two co-founders are Matt and Alex are my heroes. I mean, to this day, I just think the world of them and the team and culture they've built. And I went over there, and it was just clear that it wasn't quite working. My deals were just below the threshold, and the ones that I believe in, I couldn't get buy-in for, and it was just never quite got traction. And after 6 months, they were telling me very loudly, slow down. You don't need to be in a rush. You're here, and don't kill yourself, because I was boiling the ocean. You don't like these? Let me go find everything else, and I'll go find everything else and everything else. And I had good friends, including Lou Sokolowski, who's a great friend, telling me, I'm really worried about your health. You can't do this to yourself. And I wasn't going to have it, because I was not going to disappoint my heroes. I was going to be successful, even though they were telling me to slow down. And ultimately, after a year, they just said, it's not working out. And they were absolutely right. And I didn't want to hear it, because that was disappointing on levels that I can't even tell you. It was heart-wrenching. And at the same time, I knew they were absolutely right. And they were incredibly generous to me on the way out. They were very fair. And I'm actually partnered with the brother of one of the senior Garnett Station guys. So my partner is Odie, who's the Haramati, who's the brother of Rafi Haramati. So we have a great relationship with Garnett Station, and they're showing us deals, we're showing them deals, and it's a path that I never would have envisioned. I thought I was in that job for life. I was done as far as frankly, I was spiking the ball, and but it just wasn't meant to be. It didn't work out, and at 53, that's a really hard life lesson to take, but it's turned out to be a blessing. They were absolutely right, and they were watching me fail slowly, but fail, and I just didn't know how to come to that conclusion. I couldn't accept it.
Someone, Dan, may be listening to this and they're in the exact situation now, right?
Mm.
I'm curious what your process was. Because right now you could talk about it, but at the time it seems devastating. I'm not saying the world is ending, but like a big shift from what you thought to you were going to be doing to what you're doing. What was your process after you maybe started to come to terms with, I need to figure out what's next?
Well, let me tell you, I'll answer that question. I'll tell you, before, when I was joining, one of the things that when I was so excited about joining them, and about this shift from lending to private equity, and the world was going to hear it, right? So my identity for 14 years had been Comvest, but no, 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 no. Now it's Garnett Station. And I mean, Jeremy, when I joined, I had a jersey made, I had a helmet made, I had a football, I had shoes. I'm not joking. Like, I walked in.
Not Notre Dame, but
Well, it was a Notre Dame helmet with the GSP logo on it. I mean, you can't make this shit up. I was just like, and my mom, I'll never forget, said, Dan, are you sure that feels like, a lot? Why don't you wait till you close the deal? And I just couldn't hear it. I was like, no, 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 this is going to be great. This is the best thing ever. And it was, yeah, I was cannonballing, hey, world, check me out. I'm Garnett Station now. And so, to answer your question, the hardest part was that I had been out there telling everybody, look at what I did. Look at what this is. Look at this partnership. Look how great we are. And then I wasn't. And it wasn't my choice. And so it was devastating. And And again, they were absolutely right. And it was an act of grace. And so for me, it was that kind of figuring, okay, I need a new identity now. What is my identity? And I decided I want to call the shots, not literally, but I want to be able to pick who I'm going to do business with. I spent 30 years.
Yeah, because you got to get all your deals approved, and you're like, this is
Yeah.
amazing, and it may be too big, it may be too small, it maybe doesn't
Yeah.
fit, and you need all these approvals.
And exactly right. And in many cases, I was bringing people that I really believed in, and bringing them. And I'm a big-hearted guy, and so I'd kind of bring them to the IC, and they're like, "Yeah, nah, not for us," and it would break my heart. I took it too personally, just to be honest, between you and I as a deal guy.
Yeah.
But that's my part of my energy. It's just like committing myself, like, let's do this. And so now I get to pick. Odie and I get to pick, and actually Odie's a great partner for me because he helps me figure out, no, Dan, you're being you're being too emotional on that one. That's a really good person, but it's not a great deal, as opposed to here's a great person with a great deal. And so it's a great yin and yang. And I think for me, everyone said take some time off when it happened, and I couldn't. I just felt like I need to get back in the game. I need to go build again. I'm excited about this next chapter. And there was some licking of wounds for sure, but then it was very quickly I realized this is a very unique opportunity to partner with a guy that I believe in. And I will tell you, we're having a blast. We're less than 6 months in, and we're working with some just absolutely killer clients and having a ball.
Yeah. Well, I guess it's called the overnight success after 30 years. So, but no, I mean, it's really admirable. I mean, you just go all in, and like you can never, someone can't go back and go, literally, I gave it literally everything I had. And if it works, it works. And if it doesn't, it doesn't. So
Yeah.
I think that's a testament to your character, even though you had a helmet made and everything. Like, who wouldn't want a team member that comes in who has that type of commitment and enthusiasm?
Well, I'll tell you,
Regardless, you know what I mean?
I did think I told Matt and Alex on first day, I said, don't worry, you don't need a restraining order. Yeah, it was a little over the top, Jeremy, right? You're like just objectively looking back. No, I'm like, oh man, that was actually here's
You're like, will you sign my helmet? No.
this is funny. The day I got there, my first day reporting in, I had my uniform on, right? I had my helmet, I had my shoes, football.
I need to see a picture of this.
I'll show you. So I'm at security, and this is in August, right? In the Hamptons. Some people are in the Hamptons. People are working remotely. And security go, who are you going to see? And I'm like, it's right here, Garnett Station. What do you think I'm going to see, right? And he's like, okay, I'll call. Calls. He's like, no one's picking up. I'm like, wait a minute. So are you sure they're expecting you? And I'm like standing in the lobby. People are walking past me, Jeremy. Guys are just walking into work, right? They're like, who is this weirdo? Like, what is going on? It was, in hindsight, it was kind of a sign that yeah, it wasn't meant to be. It was like it wasn't peanut butter and chocolate. I'll put it that way.
No, I'm trying to visualize that. I have to see a picture. Talk about partnerships for a second, right?
Mm.
Because you go from working at these companies, you need other people's, decisions and approval and stamp on it potentially, and you still decide to have a partner. Talk about why and what were the compliments that you saw, with your personality in Odie?
Yeah. So, listen, I know myself well enough to know that I need a partner. So yes, relationships are important to me. I needed a partner that understood the power of my relationships and the depth of my relationships. And I think, Odie and I balanced each other out really well in that I'm more strategic, more sort of, a network built over 30 years, a reputation built over 30 years. Odie is a young, aggressive ex-banker, very entrepreneurial, energetic, incredible network that he's built just with being tenacious. And it's a really good yin and yang. We just, I think he's a great golfer. I'm a terrible golfer. So, that balances that nicely. But I think it's just a complement of kind of more strategic skills with tactical skills. And He's a little bit more. He's a little bit more objective than I am. Again, I'm the kind of want to make everything happen, believe in everybody, want to make everybody happy. He helps me be more balanced about that. And so yeah, it's been. I know that left to my own vices, I would fade out pretty quickly because I would be trying to make everyone happy, and I
Yeah,
would be making no one happy.
because it's key. And I ask this, selfishly, how did you think about, okay, identifying your key strengths so that you can focus on them and also surround yourself with people to complement you? How did you think about identifying your key strengths? What are some of them that you think about? Because
See,
I figure like sometimes strengths is like it's not obvious to ourselves. At least I can speak for myself because it's just something that comes naturally. So like I don't think of it as a strength per se, right?
yeah,
So
yeah,
I'm curious how you kind of identified your key strengths and what you found there.
yeah. So look, I think I wish I had been that analytical about it, Jeremy. By the way, I mean, my dad was a big fan of T charts. He loved T charts, and I should have run out of T chart to exactly what you're asking. But I would say like my strengths are that I'm energetic, I'm passionate, and my weaknesses are that I'm energetic and passionate. Right? I mean, it is absolutely cuts both ways, and so I needed someone that's willing, that's can take a more cold-eyed look at things and help me be objective. And that's what OD helps me do, is make sure that at the end of the day, what we want to make sure is when we engage with someone, we are going to engage deeply. We're going to get the deal done, and we're going to help them not just short term. We build long-term partnerships where we're helping them think about growth through different stages of the growth of their business. And so we're looking to build deep, long-term partnerships, and you can only do that if you have someone that's objectively able to identify this is a good match of resources, not just because I like this guy or girl, but because it's actually objectively the T chart works, the resources line up, and there's a collaborative mix.
You have a lot of experiences in all these other companies you worked with. I'm curious, what service, when you came to start the company, what services were you thinking of offering? Right? Because there's a lot of things you could do for companies, right? And then maybe what services did you decide on? And maybe you expanded them from the first thought, maybe not, but talk about what services you decided to focus in on.
Yeah, from the beginning, we've known that it would start with capital raising. So, and it's not just capital raising, it's capital raising from 30 years in the industry. So knowing the different types of capital that are available, knowing the players that provide them, what they can and can't provide, not what they tell you they can and can't provide, but what kind of partner they'll actually be, because from having been in the trenches. And so it's not just, when I say capital raising, I don't mean just, hey, we'll find you 20 million of equity, or we'll find you 30 million of debt. It's no, let's sit down and talk through. It's an advisory service. We're really helping you think through. Sure, you could raise 20 million of non-control equity. Maybe you should consider selling to a control private equity firm and rolling a really big piece where you might get a second bite at the apple. Maybe not. Maybe you shouldn't even raise equity at all. Like, have you thought about this type of debt where you can really scale the business to the next level and get a better valuation when you raise that control equity? So it's bringing a private equity mindset to founders primarily, but also to independent sponsors. Just think of it as we're like an active board member. So that really it's more than, it's really strategic growth options is how I would think about it. And then the way some of our service offerings are changing is we've realized, oh, we have access to a lot of other services that we don't provide, but we know the people that do. And so we'll bring them to the table when appropriate. So whether it's a fractional CFO, CMO, whether it's a consulting firm like Graybox Intel is going to come in and do customer diligence at an independent sponsor pricing, whether it's an insurance firm, an accounting firm. Like, we know all these people, we can bring them to the table. preparing investment materials, right? Just making things look buttoned up so that you can run the right kind of process, get the right kind of outcome.
So from the standpoint of, let's talk about founder-owned businesses for a second, are they usually coming to you when they're in that $3 to $15 million of EBITDA range? Is that, yeah. And so what are some of the things they may be surprised out about with options they didn't think about because of your experience with capital raising?
Yeah. So listen, I think founders, if they don't come from investment banking, if they've just been building this business, they haven't really needed to think about capital options. In a lot of cases, the best businesses are self-funded, right? And so they're not even thinking about raising capital. And they're not thinking about taking it from being a small business to an enterprise, right? And that's not there's a distinct contrast between the entrepreneurial mindset and the operator mindset, right? The entrepreneur can build a business, start a business. That's a superpower, right? But not many entrepreneurs can scale the business. The operators needed to come in and make the tough decisions and the investments needed, and the investments require capital. And so I think the thing it's not surprising me, but a lot of founders, it's amazing what they've started. They've started a restaurant from scratch. They've taken it to 20, 30 locations. They never thought that they would need to think about raising capital or entering new markets. And they've had it in the back of their mind, but it's really what they've relied on is effectively some business brokers or the country club. Their buddies who've done it before, and everyone has their opinions but they haven't had a really reasoned, sort of long-term approach.
They may have grown organically in the beginning. Like we go from 1 to 2 to 3 to 4, and they putting fuel on it.
They've been busy just managing their own success and growth, right? And they built an amazing platform, and they've gone from 0 to 10 to 20 stores. They've entered a couple markets, and it's really, they haven't had the time because they've been so busy just trying to, put out fires as they've grown. They haven't had time to step back and think, okay, how do I want to capitalize this business? Is there a bigger opportunity if I raise capital? And if I suffered some dilution, could I grow the pie bigger, right? Could I create a more valuable stake for myself and all my shareholders if I do take a little bit dilution? Or maybe I want to take dilution in 12 or 24 months and use the debt for the next stage of growth. So it's really, that's why I say we want to go deep with a few groups rather than have a million clients. We really want to create opportunities where we know that business cold, and we're able to be very objective. And part of our business model is we take equity stakes in our clients, and that aligns us for long-term growth. We're going to benefit from their success, and we're going to feel their pain if they're not succeeding.
Give me with the capital raising, you mentioned a few options that you've presented to people. Can you just go through a few just to give people a sense?
Sure.
Give an example.
Yeah. So, the simple is commercial bank. You go to your local bank, they're going to be very conservative and very cheap. And then you've got mezzanine providers that'll give you a little bit more flexibility. They're going to be more expensive. But they're going to give you a lot more operating flexibility. Commercial bank's going to be very tight on operations, and it's going to hamper what you can invest in and where your capital can go. And I would say there's control private equity, of course, and that's been a massive grower the last 30 years. It's remarkable to watch the way private equity has grown, and its success has been key to helping solve. If you remember 20 years ago, there was a massive pension crisis, and private equity has been a huge part of helping to make sure those get more properly funded. And so it's benefited an awful lot of pensioners. And then the class that's really growing the last 5 years, certainly it was around 10 years ago, but in the last 5 years is non-control equity. And it's got a million different flavors from, pref equity to you've got holdco notes. And so just a whole lot of different ways you can structure paper that might have a cash component to it, might be PIK so that you can keep the capital in the business, can range from anywhere from a 10 or 15% stake up to 45. And in many cases, it can be the path to a controlled transaction. And so it's sort of giving you an opportunity to get to know your partner before you give them control. And then ultimately, once you realize it's a beneficial partnership, in many cases those become control partnerships, and the founder is able to get a couple different bites at the apple.
Because then the PE will sell again, and they've rolled in a certain amount of percentage into that deal. They may have taken some money off the table, but rolled a certain percentage in there.
Exactly right.
Yeah.
Yeah, and there's opportunities. You've seen founders get 6 or 7 bites at the apple. It's unusual, but
Yeah.
far from unheard of, and it's not uncommon to get 2 or 3 or 4 bites at the
Yeah.
apple, and each bite can get bigger if it's the right kind of partnership.
Yeah, I'll give a shout to Todd Taskey, who runs the Second Bite podcast. He specializes in digital agencies, pairing digital agencies with private equity to help sell digital agencies. So it's a really interesting niche. Maybe you guys should chat at some point. Todd's a great guy. We run his podcast, and I've learned a lot just through listening to his episodes. So people can check out the Second Bite podcast. I want to
Great.
talk about the restaurant vertical, right? You mentioned restaurants expanding. You have a lot of experience there. Can you talk about some of the things you've seen and done there?
Yeah, so this was at Comvest. It was my lieutenant Nick McClellan and I decided we thought we were looking for. You're always it's when you're a lender, it helps if you have a focus on verticals because you get to know that vertical well. You get to know the players. And restaurants is a relatively less competitive vertical. There's a good reason it's less competitive because it's pretty risky, and a lot of lenders have lost money.
Every time I go in a restaurant, I'm like, there's no way I want to run this thing. The inventory goes bad after like a couple days. The margins are tight. It seems like a terrible business.
No, it's challenging.
I'm glad people run them because I want to go to them, but I don't want to own one.
No, and the real challenge as a lender is when things aren't going well, they can be really, really difficult. I mean, you're putting good money after bad in some cases, and so there's no question. There's a trail of heartbreak in restaurant lending, right? But we had a thesis that there's a type of restaurants that's more durable, and they have to have been around for a long time, 15 years. They have to have many units that have proven stable unit level economics over time, and you've got to have a really strong private equity sponsor, an experienced operator. And because they're less competitive, you can like a typical LTV in a non-restaurant transaction is going to be 65%, 60%. In restaurant land, it can be 40 to 50%. So you're doing you're advancing a lower LTV, and you're getting better pricing because it is less competitive. And so you have to keep the bar really high. That's the key. And my partners helped me make sure that I didn't get us into trouble. I tend to be optimistic, and so they would kind of help me understand. No, Dan, that's bad. that's not a good business. Yeah, he's a great guy, but that's not a business we can lend to. And so we found some really strong. I mean, we built the restaurant vertical around Garnet Station, and we found, in lending with them and watching them manage their restaurants through, the toughest challenge you can imagine in COVID. They proved we had many private equity firms that we invested with in restaurant land. Garnet Station was one of the youngest firms in our portfolio, and they outperformed everybody else in terms of the way that they provided resources and rolled up their sleeves and got resources to the ground. It was remarkable.
How did they pivot? What did they do during COVID to make sure things didn't just crash and burn?
Well, they had experience in working through some tough situations with restaurants. So they just, they got their people out into the field, for restaurant operators, people that had, most of the people that they were investing with were founders. And so, they had great experience, but they hadn't been through that type of challenge before. Who had? But it was really just understanding that we need to prepare these businesses for a long-term challenge, right? This could take time, and we needed to provide some incremental capital, but we think they can come back stronger on the other side. This is unfortunately going to wipe out a big chunk of the restaurant mom and pops, and the groups that are better capitalized. I mean, the real answer is they properly capitalized them, so they didn't have a lot of debt, and so they could service the debt comfortably even while the restaurants weren't open, and they got the restaurants up and running quickly. And they were some of the first ones up and running in our portfolio, and they performed great on the other side.
Talk about just, that growth and some of the things that you saw and did when we talked Comvest when you're there went from 250 million to 12 billion, right? What were some of those key inflection points or things that you look back on that you learned from?
It's understanding where you matter as you get bigger. So when you start in the lower middle market, it's a less competitive market by definition. There's just less people playing there. And the challenge is going from doing 10 or $15 million deals where it tends to be much less competitive to 50, 75, 100, recognizing that there's a lot more competition there. So you really have to focus on where you matter. So what that meant for us at Comvest was, let's really focus on verticals. Let's build resources, operating partners that we can use for diligence. Let's build internal teams that can just rip this industry apart, like just in their sleep, right? And then as we do that, as we go deep, we'll develop a reputation amongst the private equity community for being the guys that know healthcare, that know restaurants, that know consumer. And so that really, that was the lesson learned was don't kid yourself that you can continue to be a generalist as you grow. That is a very, very difficult. You tend to get to adverse selection, frankly, and that's can be a disaster for a lender, because this is one of the things that if you're not a lender, you don't know this. It's not rocket science, but in private equity, you can afford to have a bad deal. You can't have many, but you can afford to have a bad deal because you get all of the upside. So you can earn 3x across 9 portfolio companies and have a dud, and you're raising your next fund because across the fund you got that upside. As a lender, you don't get the upside. It's a really challenging to scale a credit platform, and because of those dynamics, you just cannot afford to take losses. And so what determines success for lenders long term is not the number of losses, it's the severity of loss. You can have a number of bad performers as long as you get the vast majority of your money back and have an otherwise healthy portfolio. And that's what we learned at Comvest, and that's what helped to scale.
First of all, Dan, I have one last question before I ask it. I just want to thanks for sharing your stories and your journey, and people can check out pinhighstrategies.com. My last question is just some of the mentors and colleagues that you've respect that maybe you learned a lesson from over the years. Who are a few of those mentors and a lesson learned?
Yeah, so I mean, I've had so many people that have had a huge impact, and I'm going to leave somebody out, but I'm going to start with Brian Gallagher, who was my first mentor back at Arthur Andersen and remains a very, very good friend. He's someone that I've just collaborated with and have a lot of respect for. Ken Leonard, certainly, he was my mentor at Heller and hired me at Dymus, and has been just an absolute killer partner for me over time.
Is there any from Ken, any lesson you learned from him or something he imparted on you?
I think from Ken, it would be love your energy, be careful. So he could see that it was, again, it goes back to that blessing and curse, right? It's like, man, it's great that you've got all that energy and all the enthusiasm and belief. Just be careful because it can lead you, just make sure you're being objective. So he's helped me stay objective over the years. My partners, Greg Reynolds and Jason Gelbert and Robert O'Sullivan, Comvest, just learned a ton building with them, working with them. And then I would say Matt and Alex at Garnet Station. I mean, that was a master class in private equity. I got to see the inside workings of one of the best platforms in the business right now. I mean, it was absolutely, I have no regrets about having taken a chance, and it was a big risk. We said it on day one. Who knows if this is going to work, right? And it didn't. And I'm happier now because I'm working with someone that I'm having incredible chemistry with, and we were fortunate that we've had some incredibly good clients that have tapped us, and we're excited for what the future holds together.
What were the learnings from Matt and Alex? for you?
Oh man, I mean, figuring out where you matter. So, really being honest with yourself about why are we so special? What do we bring to the table that's unique to this counterparty? So if you want to be disciplined on price, which they have been, that's why they've had so much success. They've figured out how to build collaborations where price wasn't the determining factor. It's the counterparty decided, I want to work with you because I see you believe in what I am building, and you bring resources to the table that help me. By the way, price wins 9 times out of 10. Let's be honest. So you have to have the tenacity to really, flip over enough stones and commit yourself to all of those conversations, because you don't know out of those 10 conversations, out of those 100 conversations, which one or two or three is going to be the one where the founder says, you know what, price isn't the most important. Collaborative partnership is, and I'm going to grow the pie bigger with you. And again, that's second bite, third bite. So that's what they've built the firm on. It's just believing in their founders and bringing best in class resources to them. And it became just a reference cycle, right? People would come to them because they heard the story and they heard the founder raving about them because they provided the kind of support that only they could.
Dan, I want to just thank you. Everyone check out pinhighstrategies.com. I feel like these are different chapters of your future book. Some of the mentors, colleagues, and like something they said to you, like chapter is love your energy, be careful is one chapter. But thank you. We'll see everyone next time. Thanks so much.
Thanks, Jeremy. It was a blast.
What I got, you can't buy. It resides between my eyes. Walked through the fire, came out better on the other side. See, life's like a beach if you find the sailing right now. I'm feeling like 100 grand.